Hello everyone. As we do at the beginning of every quarter, we are going to share with you the main insights that can be extracted from our digital top-down methodology. Our method consists of evaluating the attractiveness of European equities with regards to four complementary pillars of analysis. The first pillar relates to the economic momentum in Europe. The latter is literally collapsing, reaching levels observed only 3 times in 20 years. This situation is artificially triggered by central banks in order to fight inflation. Never in economic history has a hyperinflation situation been able to be curbed other than by a recession, even a temporary one, and central bankers know this well. Furthermore, sentiment indicators are hitting historic lows, a sign that psychology is depressed, and this is generally a contrarian indicator, which in the past has systematically identified good entry points for medium-long-term equity investors. The second pillar is the ECB monetary policy. The ECB is finally tightening its policy, and since our last quarterly update has just put an end to almost 10 years of negative key rates. The rate hike should take place until at least the end of the year. The aim is, quite rightly, to act quickly, while more than half of the current inflation is exogenous and explained by the rise in food and energy prices, before being able to resume with a more accommodating monetary policy from 2023. This is clearly a key element at this stage, and the recent sharp fall in inflation expectations may give rise to some optimism. The third pillar of analysis is European market valuations. The risk premium of European equity markets stands at 7.1%. This is a generous level compared to the historical average of 5%, especially as the analyst earning revision momentum remains bullish. A return of the risk premium to its historical average could theoretically cause the European equity markets to rally by around 20%. It is therefore easy to understand why the next quarterly publications in Q3 will be particularly scrutinized by investors. Finally, the fourth pillar deals with the behavioral aspect. The upward momentum of equities has been broken as all major international indices are trading below their 200-day moving averages. However, the European indices are maintaining a long-term bullish chartist configuration as long as the indices remain above the secular technical support corresponding to the historical highs of 2000 and 2007. The latter held in the first days of March and is being tested again at the beginning of the quarter. In conclusion, you can say that despite the obvious lack of short-term visibility, European equities could surprise in the coming months. The economic momentum is slowing down, but this could only be temporary. The central bank is violently raising interest rates in order to quickly counter inflation, but could reverse its policy as early as 2023. The valuation is historically attractive, especially for the most value-oriented components of the stock market, and the long-term chartist configuration of the European market remains bullish, as long as the secular support remains in place. In this context, the next inflation figures will be key and could bring out general relief. Thank you, and see you next quarter for a new video by Shaheen Capital.